markets kicking off the week in the green. Our next guest says there are 3 things that could take us back to new all-time highs. Phil Camporeale of JPMorgan Asset Management joins us now. Okay, 3 things. What are they?
So the first is fundamental. So we do not have a recession, in our view, over the next 12 months. Usually when that happens, stock market tends to trade higher. And that, of course, is driven by what is debatably the strongest U.S. consumer we've seen all cycle. Second thing is valuations. This is not an expensive market. We may be 1% away from all-time highs, but from a PE standpoint, how much are investors paying for earnings? About 17 times. 25-year history is about 16.2 times. Nowhere near euphoric. I think the technical side is probably the strongest, Melissa. So you have about $800 billion that flew into bonds and cash funds this year. A tsunami of flows into cash funds and into fixed income funds, about $200 billion out of equity funds. And probably the most important driver is the Fed. And Tim, you've mentioned it. Biggest difference between this year and last year. The Fed on October 3rd of last year, we're almost at a year anniversary, said we're far away from our neutral rate and we're going to be hiking rates in 2019. And now they're in an easing cycle. And usually this whole cycle, when Fed keeps financial conditions easy, that is a tailwind, not just for prices, but also for PE multiples.
Why is it presumed that the money that has gone into bond funds and money markets or cash, that will go into equities? So
I think it's hard to say that there's something that's cheap in this market. I think a lot of people said that. I will say, though, that cash is really expensive to hold. So I think, bond funds are one thing. You need kind of a sharp rise in interest rates.
So how much specifically is in cash versus bond funds plus cash, which is, I believe, what you gave me in terms of the $800 million?
Yeah, so it's about half and half.
Yeah.
So about 400 odd into fixed income, about 400 odd into cash. Because remember, coming into this year, cash was the only asset class that worked last year. Right? Cash was the only positive asset class. So everyone was saying, let's go invest in cash. Just like the year before, everyone was saying, let's go invest in EM because it went up by 38 in 2017. So there is, I think, kind of an emotional pain trade here that causes the market to grind higher. I think that's the path of least resistance still.
So where are you on earnings? And if we get a spate of companies that take down their guidance because the trade war is on and because tariffs look like they're going to come into effect anyway, what happens to your estimates? So
lukewarm on earnings. I don't want to make this an earnings story that we're going to have double-digit returns on.
So versus consensus, you're below.
So we're at about 3 or 4% on earnings. You get another 2% in dividends on top of that. That's kind of mid to high single digits. What you do get, though, I think, is the PE expansion. If you go from, say, 17 to 18 times, that's 5% right there. And I think in a world where you have, and I want to caveat this.
In a world
where you have some sort of de-escalation, not a grand trade deal. That's not what I want to say, but a de-escalation of trade, which is, I think, politically where China and the U.S. look like they want to do right now. I think you can get a little bit of multiple expansion from here. But ultimately, until the election next year, there's going to be no great trade deal. Also, volatility is cheap. Just buy a call option on the S&P and get some downside protection.
So in a world where, the 10-year went from 147 to 180, backed up a little bit, are rising rates a bullish thing for equities?
From these levels, they are. They definitely are. And 2's inverted in August. And if you bought the equity market the day 2's inverted on August 26th and closed inverted, S&P's up 4% here. Why? Because rates have actually backed up in September. I think a trip down to 1% on the 10-year, if the Fed does have to go 3 or 4 more times from here, that's a bearish story for the equity market.
I would push back and just say you've been lauding lower rates in terms of equaling PE expansion and forcing people into the equity market. Higher rates to me would just be actually the opposite of that, no?
Yeah, so we were most scared last year in February when people were calling for a 3 or 4% 10-year Treasury. That's a much different financial condition story that was at that point driven by a couple of hot inflation numbers. It lasted for like 2 weeks, right? I think from a trip from 175 on the 10-year to 225, investors would love that because I think that would mean that financials were in better health. Maybe the curve would be a little bit steeper in that environment because the Fed would keep the front end on hold. And I think that would be a confidence boost for the market.
What's your target? S&P.
So the S&P, mid to high single digits over the next year. I mean, we're not talking about a fist-pounding view on the S&P because we can't get there with earnings just yet. But it is higher than here. It's our highest confidence bet.
Phil, thanks. Good to see you. Phil Camporeale, JPMorgan.
So I get Phil's premise, and I understand even...
Sounds like a big butt's coming. Yes.
No, because it's based on the Fed not disappointing. Never underestimate the Fed's potential to disappoint at a meeting or be too wordy at a meeting or in between. For those reasons, that's why I'm a little bit hesitant to say off to the races with the S&P.
See, it's interesting when what did you just say to Steve before? Sounds like a big buzz coming.
Yeah.
I got all excited. I thought like Kim Kardashian was coming on the show for the first time. She actually followed me on the Twitter briefly.
Wow.
Just briefly.
Briefly, years ago.
Probably by
Also a decent
accident.
Sir Mix-a-Lot song, by the way.
Who's that?
Sir Mix-a-Lot.
Baby got back.
Not where he likes.
Oh, right.
He likes
This is a
something.
terrible
He likes
conversation.
something.
Now.
You brought it up.
Terrible conversation. I didn't
Yeah,
bring
you
it up.
took it.
You brought it up.